You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Investor anxiety was heightened this week after a wider U.S. trade gap and downbeat foreign economic data cast doubt on overseas demand for American goods and helped trigger a global market rout. Adding to investor fears was word from the Fed that it would use mortgage bond proceeds to buy more treasuries to boost our slowing economy. But more importantly, it acknowledged that the U.S. economy is weakening. And in doing so, the Fed delivered its most bearish outlook in more than a year. The market took all of this as the clearest sign yet of concern over the economy by the Federal Reserve. Our stock market had a mostly lower week. Some blue chip heavyweights led some broad declines earlier in the week, especially as signs of weakening growth in China exacerbated fears of global economic slowdown. Let's turn now to our market technician, Kevin Matris, who joins us with a little bit of a technical picture on what the market is looking like. One bright spot this week, I do have to note.
Oh, there is one?
There is one bright spot, yes, that the July retail sales rebounded. Up 0.4%, and the June drop was revised upward a little bit. So that was one bright spot. But generally speaking, my friend, where do you see technical support and resistance?
You know, it's funny. I have said before that I thought we were going to be trading within a range, and that is exactly what we're doing. So check this out. You can see the range being established on the Dow between 10.7 on the upside and around 9,800 on the downside. And for now, it kind of seems pretty well confined to that area.
So technically, what lies ahead?
Well, technically, there is a larger pattern that is forming, and unfortunately, it looks a little bit more ominous. The larger pattern is a big, potentially bearish head and shoulders pattern. And you can see the left shoulder forming in the beginning of the year. The head had formed in April, and just this past Monday, it looks like the completion of the right shoulder. Now, the bottom of this pattern is called the neckline, and that comes in at right around 9,800. So if we break that neckline and go further, the pattern suggests we could see a move all the way back down to 84.75. Now, that, of course, doesn't have to happen, but that is what the charts are saying right now.
Alternatively, though,
well, alternatively, if we can keep it together at these lows, if that happens and we can then run back up to 10.7 and then through it, we could see a move about the same size in the opposite direction because a failed head and shoulders pattern will oftentimes break out explosively to the upside.
What's your gut telling you?
Well, for now, I kind of think that we're probably going to trek lower for a while, test the neckline of this pattern, which also happens to coincide with a long-standing uptrend line that you can see on this chart. That goes all the way back to the lows of last year. And what the market does at that critical juncture is probably going to set the tone for the direction of the next 1,000 points.
All right, let's go down a little bit of a different path here.
Okay.
Give me a little bit of your weekend wisdom on how to make money when a market goes in either direction. Options you feel affords opportunity for investors, right?
Yeah, I really do. You know, first off, when you're looking at options, there are a ton of advantages. For one, when you're buying options, there is a limited risk. So under the worst case scenario, you can never lose more than what you committed to a trade. Two, there's a great deal of leverage, meaning you can use only a fraction of the money that you would normally have to put into an actual stock to get into there. So 1 and 2 really tie in together. You can get into a position for a fraction of the cost, and you still have that safety of a limited risk. 3, too, there is a flexibility, a ton of flexibility, because there are strategies that will let you make money if it goes up, strategies that allow you to make money if it goes down, and unlike stocks, there are option strategies that will let you profit even if the underlying stock goes sideways. You cannot do that if you're just sitting with an actual stock. Moreover, you can even be wrong on the actual direction of a stock up to a certain point and still make money even if you guessed wrong. But the benefit with all of this stuff is that it is a lot easier than people think.
How so?
Well, for example, if let's just say you're bullish, right? One of the easiest and most common strategies is to simply buy call options. If you're bearish, you can buy puts. The cool thing, we were just talking about the potential of going up, 1,000 points or down 1,000 points. Mm-hmm. If you don't know which way the market's going to go, you can actually buy a straddle or a strangle, and you can make money in either direction if a big move takes place. You can also write calls and write puts. Writing calls and writing puts is cool because if you believe a stock won't go above a certain price, or if you believe a stock won't go below a certain price, you can write options and actually collect a premium while doing so. Either way, there is a ton of flexibility afforded with options, and if you're not using options right now in your own trading, you should seriously consider adding them to your portfolio.
Okay, and very quickly, more volatility still ahead through the summer?
Absolutely, there's going to be a lot of volatility.
Alrighty, and there's more still ahead in Profit from the Pros. We want you to stay with us. Here is your Bull and Bear Stock of the Week. A farm retailer and a digital imaging company make up our Bull and Bear of the Week this time around. Shiraz Mian here with us once again to clue us in on each of these companies. Now, the Bull Stock of the Week, Tractor Supply Company. It's a NASDAQ stock traded under the ticker TSCO. What makes this a bull?
Three main reasons, Terry, for picking Tractor Supply as a bull. Just a brief introduction on the company, I'll give you as well, but the three main points, it's a very unique growth story in the retail sector. Mm-hmm. They have a very strong margin gains outlook and a solid balance sheet. It's a roughly 2.5 billion market cap. A hardline retailer with about 950 outlets all across the country. And it's the largest retailer in this farm and range equipment segment, and they have a pretty good niche position. The growth profile looks very good. The company is planning on roughly doubling its retail outlets from around 950 now to about 1,800 over the next 7 to 8 years.
Yeah, certainly a unique market position.
It is, and it's a type of a market niche which is very easily defendable for these guys. The competition is very fragmented. They constantly are gaining market share from these independents and local co-ops and local chains and independently owned outlets. So the growth outlook is very unique for these guys through market share gains and also the expansion of their footprint. Mm-hmm. On the margin side, they have been implementing a number of initiatives in their merchandise mix, in their sourcing, in the price optimizations, which is helping them steadily gain gross margins. They have been averaging about 20 to 50 basis points. And my sense is that trend is sustainable over the coming quarters. A key margin improvement initiative is in the private label merchandise segment. They have grown it to about 20% of their total sales. They are targeting to increase it to about 25%. So a very strong opportunity there.
Okay.
The size also gives them advantage there. And they have a very solid balance sheet. It's practically debt-free. They produce good free cash flow and pay a dividend, yielding about 1% right now.
All right, let's move on to the bear. Eastman Kodak, EK. That may surprise a few people. What makes it a bear? Well,
two main reasons. Number one are structural and competitive issues that has really been weighing on this company. Number two, there is lack of visibility about the company's business prospects. Just briefly on the structural issues, this is one of those companies who have a very storied past and were on the cutting edge of technology in its day. But then time has passed it by. And now they operate and compete in products and segments that seems to be beyond their prime, whether it's in digital imaging, whether it's in the photo film and in the standalone cameras or in printing. The trend on the technology and on the demand side seems to be moving completely away from where they stand. And it seems like they are constantly losing their top line grip. Balance sheet is very weak as well.
We got to leave it right there because time passes here too. Screen of the week is next. Screen of the week, an overview of a timely strategy aimed at helping you become a more effective stock screener. Now we're going to talk about using ROE for your ROI, whatever that means. Ro for Roy. Kevin Matris, top stock screener, back with us once again to explain all of this. Sounds to me like you're talking about return on equity. At least I got that part of it, which is a pretty valuable indicator.
Yeah, return on equity, or ROE as it's commonly known, is often used as an indication of a management's efficiency. Also, too, it is a favorite criteria of a lot of money managers, individual investors, including myself, because it tells you how successful a company is at being able to use its shareholders' equity. Also, too, I believe that if you can find companies with steadily increasing ROEs, those companies are generally looked at as being better managed because it shows that attention is being paid to details.
All right, give us the definition first off for ROE.
Well, first off, return on equity shows how much profit a company is making on its shareholder equity, which includes reinvested earnings. So check this out.
All right.
Return on equity is simply net income divided by shareholders' equity. Now, the income portion of this equation is listed on the income statement, and the shareholder equity portion is the difference between total assets and total liabilities. That item is listed on the balance sheet. Now, the ROE is always shown as a percentage. So a company with an ROE of 10%, that means 10 cents of assets have been created on every $1 of shareholder equity for a 12-month period.
So how are you using it?
Well, I think ROE is a great item to use regardless of what kind of an investor you are. And in general, you want to see the ROE increasing. On the flip side, I believe that if you see an ROE decreasing, I believe that is a good potential alert that something may be wrong at the company. But another great way to use ROE is to compare it to its industry. For example, some industries do require a greater amount of assets to run their business. So a great example would be looking at retail versus the steel industry. The median ROE for the retail industry is 11.8%. while the steel industry has a median ROE of 5.8%. Now, the reason why I point this out is because if you set up a screen and all you did was screen for absolute numbers, it is very conceivable that you may miss some great stocks in some great groups, but if you are comparing it to its industry, you'll be able to find the best stocks within those industries, and I think that is the proper way to use it.
Okay, powerful indicator with many different ways to use it.
Yeah.
Parameters for the screen.
Parameters for the screen. The two main things we are using in this week's screen is this. I want to make sure the ROE is greater than or equals to the 5-year average, so we want to see an improving ROE over time, and we want the ROE to be better than the median for its industry to find the top performers.
All right, and stocks that came through?
There's a bunch of stocks. Here's 5 of them. CarMax, Tempur-Pedic, Tractor Supply Company, Union Pacific, and Vishay, all great companies, well-run companies.
Variety of industries.
Variety of industries, a lot of diverse sectors and industries out there, a lot of great stocks too.
How often do you end up using a screen like this in a market environment like we're in?
Well, you know, there's several screens that I would consider to be favorites, but I think it's always important to look at these things at the very least on a quarterly basis.
All right, we have more still ahead. Kevin is with us at the roundtable, so don't go away. You won't want to miss it. It is up next here on Profit from the Pros. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. The Fed's acknowledgement this week of weaker than expected U.S. economic growth going forward has really brought the fear factor back to the market, and we are going to get a read on just what that means from our regular panelists, Shiraz Mian, our research director, who actually forgot his tie today. Bill Wilton, a stock strategist for us, and Kevin Matris, market technician, who you saw at the beginning of the program, two of whom did not forget their tie today. So you're the odd man out. Let's start with you.
Okay, good.
Fed said this week, economy growing weaker than expected. Man, what news there? Did they tell us anything we didn't already know?
I'm as surprised as your question implies. I think the only reason the market has been taking it as kind of a disappointing comment is that it has had so much of gain in the preceding weeks, and it gave the Fed statement gave the market an excuse or an opportunity to cash in some of those gains. Other than that, the Fed's acknowledgement that the economy was weak, I don't see any news in that.
Yeah, really.
Particularly in this Fed, which actually talks normal English. They don't imply that you need somebody to decode Ben Bernanke's language, thankfully for all of us.
So let's apply a little decoding, though, Kevin.
Okay.
Is what the Fed said this week actually their own way of throwing up their hands and saying, sorry, folks, we got no more?
You know, it is interesting because only a couple of weeks before, they had implied that they were reluctant to provide more stimulus, and they said that they would only provide more stimulus if they believed the economy was slowing. So when the FOMC came out, I do think it kind of took some people by surprise because they came out and they actually did take action. This was considered accommodative. So when they followed it up by saying that they see more modest growth, I do think people were a little bit concerned. So I don't think they're throwing their hands up, but what they are saying is things do look like they're slowing, and they are a little bit worried, and the market took notice.
All right. So, Bill, is what we're seeing in the market on the heels of that news this week just the market's way of pricing in that public acknowledgement of the slower than expected U.S. economic growth? Or is this just what some people believe, summer stock blues, normal volatility, and range-bound market?
Well, I think it could be a combination of both, obviously. But one thing that, what I took away from this Fed news was, when they went for this quantitative easing, that's really not going to have as big of an impact as some of their other measures that they would normally have, like, dropping the interest rate a little bit. So to me, as a market participant, that says we know that things are bad, but we really don't have anything else we can do right now. So I think that's a lot of what is scaring investors out there.
So they are throwing up their hands, what I asked a moment ago.
From what I'm seeing, they really don't have anything else that they can do right now. So it says we know it's bad, and we're going to do everything we can, but we're kind of clutching at straws here. And I think that's the big reason that we've been selling off for the past few days.
Yeah. So Shiraz, is the market going forward here going to be trading more on technicals in the stuff that Kevin looks at, or more on fundamentals? Because there seems to be a lack of fundamentals right now outside of this economic concern.
Yeah, we may not see a lot of catalysts in terms of fundamental stories that can drive the markets higher. But if the market can size up and zero in on this outlook that, okay, the economy is slowing down, but we're not getting into a recession. We got some good news on the European front as well, that the European economy may not be exactly as weak as the market was pricing. And if the same outlook emerges for China and the rest of the emerging markets, then that's an outlook that should stabilize and reassure the market.
But this week, the outlook from the foreign markets, the foreign economies, wasn't that great.
Yeah, the overall backdrop and then the Fed statement has been kind of weak, and that has been providing a negative backdrop for the market. But I don't think this negative and weak sentiment will stay long. I think the market will stabilize in the coming days.
Do you agree with that, Kevin? Weak sentiment not going to stay long?
It all depends.
It all comes down to confidence, right?
We just got done talking about the technical picture, and I really do believe that the market is going to focus in on the technical picture. But going back to the Fed thing, yeah, I don't think they threw up their hands. But what I really think killed the market this week was you had this double whammy. China, they came out and they said that industrial production had slowed for the 5th month in a row. That was the worst reading in 11 months. Now, granted, nobody should cry for China because they're still growing at 13.4%. But between the Fed's acknowledgement that there's slower growth, and now you're seeing kind of slower growth everywhere else, people are a little bit concerned.
Trade gap widened in June.
Right.
That was another negative sign, right, Bill?
Yeah, and the trade gap was more alarming than some people give it credit for, because we widened almost 20%, which was worse than even the most pessimistic estimate that was out there. And what this is saying is, because it was largely due to a lack of exports, yeah, the U.S., we're improving slightly, we're spending a little bit more, but the global economy is not rebounding the way that we thought it would. So what that's going to do, that's going to end up lowering our GDP number even more. And I think once investors start seeing a GDP number that's below 2%, in that mid 1% area, that's really going to start to raise some red flags.
All right, we got to leave it there. I want you to do your top stock pick of the week as we're coming up short here.
I chose Winter Medical Group, WWIN. They're out of China. What they do is they manufacture disposable medical products, gauze, operational tools, things like that. Cheaply priced, defensive. They've got a negative beta for all those bears out there. So, it's a good play right now.
Kevin M., top stock pick.
Real quick, mine is the Andersons, ticker ANDE. They are in the agricultural producer industry, and they've got great growth rates, great valuations. The one thing that's interesting is that grain prices are higher, in large part due to the drought that we have in Russia, and I think that they are perfectly positioned to take advantage of these higher grain prices around the world.
All right, top stock pick.
Carbo Ceramics. It's a play on the shale natural gas market in the U.S. It's an under $2 billion market cap, a very strong position in a small niche market, also pays a dividend, and has a very good outlook.
They don't teach pottery classes or anything like that, right? The name ceramics kind of threw me.
That's right. It's a synthetic proppant that what they produce. So it's kind of in that vicinity, yeah.
Well, prices moving lower here over the past week anyway. What is that telling us about the market, real quick?
It's tied to the overall outlook for the global economy. So when you have all of this talk about the economy, U.S. and global slowing down, it's completely in sync, and that's where it's showing.
We'll leave it there. Thank you for joining us. That's all we have time for on this week's edition of Profit from the Pros. We'll see you next week.